Welcome to Deep Economic Thoughts with economist and best-selling author Ivan Illan. Once in a while, Ivan shares an unscripted, though potent, idea related to economics or the capital markets. This may be of interest to financial advisors and retail investors alike. Enjoy.
The Bruce Cook Conversation with your host, Bruce Cook. Trending now. Here's your host, Bruce Cook.
Brought to you by the Hoag Institutes, Hoag Family Cancer Institute, Hoag Digestive Health Institute, and Pickup Family Neurosciences Institute. Unparalleled expertise, world-class care, right here in OC.
Happy New Year, ladies and gentlemen. It's Bruce Cook, and it's time for the conversation live tonight on Angels Radio and also on the Angels Radio app. Welcome back. I'm happy to be back. I hope you are too. We have a lot to discuss in the new year, and we're going to start out when we say Happy New Year, we also say, and good health. And as my mom used to say when I was a kid, if you've got health, boy, you've got everything. Of course, I didn't pay much attention to that as a kid, but as you get older, you know the meaning is really important. So to everybody listening on Angels Radio, may this be a year of good health, plenty of happiness, lots of surprises. Biggest surprise, I think, of all is going to be our financial picture and how it impacts our major elections that are coming up. Economy is often the linchpin in an election year. It tends to matter more than just about anything else in a world that is always conflicted and crazy to one degree or another. We certainly are in that boat this year, 2024, but the economy still looms to be a large factor. It's strange, though. I don't know how many listeners paid attention to President Biden's speech this week on the occasion or the eve of the occasion of the 3-year anniversary of January 6th. It was a campaign speech. Most of it was about preserving the democracy of America, and of course it was anti-Trump. But he really didn't say that much about the economy, which surprised me personally because the Biden economy has been a major aspect of the campaign until now, but they seem to have backed off on that. Perhaps it's because as we ended the year 2024, things started to look better. The stock market did a very good job this year. Unemployment is at record lows, and there's lots of positive figures out there. Interest rate is starting to come down. Inflation is starting to meet wages. With all of that good news, you would think that President Biden and the Democratic Party would want to be pushing that more. We will find out. On that note, I want to open up the phone lines tonight. Our first half hour is going to be on the economy. And my very special and regular guest, the founder of a investment company, Ivan Illan, is going to be joining us momentarily. But before I bring him on, I want to open up the phone lines with a question. If you care to answer, if you care to participate with Ivan, who is an expert in finance and in all sorts of things related to the economy, this is your chance. My question is this. How do you feel about your personal economy? Are you stable? Is your job secure? Do you feel like your personal wealth is okay? Or are you worried? Are you on the edge? Is it good enough? Complicated question, but not so complicated. If you care to join me, the phone number, as most listeners know, 714-2-830-830. 714-2-830-830. Before I bring Ivan on, I want to say a special thank you to our sponsor for 2024. We have a new sponsor joining us. You heard it in the opening credits. It's the Hoag Institutes, ladies and gentlemen, at Hoag Hospital in Newport Beach and also in Irvine in Orange County and at various locations around Orange County. The institutes are very, very, very special places where people with very specific needs find the help they need. So thank you to Hoag Institutes for supporting this show. It's really important to me personally because quality advertising raises the bar. And I want to be proud of the advertisers that support this show. I'm very proud of them and most appreciative. On that note, let's bring Ivan Illan on. He is the founder and chief executive of Align Wealth Advisors Investment Management, headquartered in part in Los Angeles, Century City area, with offices around the country. He is a very educated man with a BA in economics and also a master's degree in philosophy. Now, there's a great combination for a talk show host. Ivan, are you there?
I'm here, Bruce. Can you hear me?
I can. Thank you very much. I understand that you wanted to go to the Chargers game today, but the traffic in Beverly Hills was so horrible you couldn't get out of your house.
That's exactly right. As we speak, I am actually staring out my window at the line of cars, limousines, and beautiful, gorgeous cars. I mean, if you want to think there's anything wrong with the economy, just look out the window, and it looks like everything's absolutely fantastic. Well, everyone's pulling up in the finest vehicles you can imagine.
Well, that's all great for me because I'm a car lover. I don't know about you, but it's a perfect – I didn't expect that statement, and it's the perfect way for me to segue into my question to start us off together. The inequity in our economy is so severe between rich, poor, and what's left of the middle class. How can it possibly seem like our economy overall is stronger than it's been, even though I made some statements at the beginning of the program that stock market's doing well, et cetera? A lot of people aren't feeling it.
Yeah, well, it makes total sense that a lot of people would not be feeling it because inflation disproportionately impacts the middle class, lower middle class, and even, frankly, upper middle class. So that's a very important thing. I think that a lot of economic data doesn't focus on, which is that there is a disproportionate impact when the price of beef goes up and the price of eggs go up and milk and, basic products, things like fuel as well. These things are like taxes on the consumer and certainly put a disproportionate burden on the middle and lower class.
How important will the economy be in this year's election? Where does it stand between war in the Middle East, immigration at the border? Where is the economy in all this? Are people going to vote with their pocketbook? I guess that's the question.
They always do, Bruce. I mean, that's what history has taught us, and history is good for something, is to reference it and see what's happened in times similar to ours. And the economy is always the number one issue. People always care about what's in it for them, what's it going to be like into the future, who can really navigate economic conditions best.
Do we really?
I was even reading something today about Trump. I mean, 2/3 of Republicans believe Trump is the guy to best navigate the U.S. economy, and it's a distant second with Nikki Haley at 8%. So it clearly is front of mind for the electorate.
Your statement about 2/3 of the Republicans feeling that Trump is the man to fix the economy. If I took the devil's advocate position on the radio tonight and pointed out all of his financial failures and all of the things that went wrong in our national economy and the debt that rose to the pinnacle of all pinnacles during his 4-year period, how do you respond to that?
Well, there's a couple of different things there. The first I would say is, his personal wealth is still quite great. He is a billionaire. So for all the failures he may have had, the guy's still worth more than $1 billion. So I certainly, look at him as having used the system to his advantage. Certainly he used the bankruptcy system to his advantage. I remember, reading Art of the Deal when I was a kid, and one of the things that really struck me was, this syndicate of bankers he got together in a room because he was going to default on something like $700 million of debt. And so all the bankers were furious to come and meet with him, and he got them all, to compromise and take less money and take less interest, and that's what happens when you have a lot of debt.
Well, you know what?
Set your terms. It's different for the average folks, but when you got that kind of debt, you can bring people to the table.
It's actually not so different, I think. I think a lot of people that don't have $1 billion have serious debt problems, and they have learned that the system can help them in a negotiating position if they handle it right. Maybe that's why so many people, so many Americans don't care about all the garbage, don't care about all the criminal lawsuits and everything. They just feel they want this country fixed. Can you define that for me, in your opinion, at least from a financial point? What does fix the country mean?
Well, I think it would mean that people could actually afford to buy a home.
There you go.
That would be a huge evolutionary step forward, for a citizen of this country who doesn't want to have to move to, a state, that has less people than, a small town in California. I mean, it's a very real dynamic that we have in this country, which is it's very hard to be able to afford housing.
But in a free market economy, is it possible? Is it possible in L.A. Orange County that we represent here tonight? Is it possible to fix that, given what's happened and given the prices that we have and the huge population vying for space?
Probably not. Actually, it's probably extremely difficult to fix. I would imagine that, if hunks of Malibu fall into the ocean, that's when you actually start to see some relocation on a mass scale. People actually start to think, maybe there is erosion that's happening at the coastlines, and but yeah, we still have a tremendous amount of people that want to be here in California, and that obviously keeps prices high. It's all about supply and demand at the end of the day.
Like everything else. You mentioned a natural disaster, the cliffs of Malibu sinking, and I have often, through very, very many periods of ups and downs in California real estate, there are 3 Ds in real estate, in sales: death, disaster, and divorce. You can pick which one you want. And that's what moves the market at times when things are stagnant. And they are now very stagnant. They're predicting, economically, I've been reading that the prediction is as interest rates slow. Apparently we're now around 6.6. Do you think that's about right?
For mortgage rates?
Yeah, mortgage rates, yeah.
I would say historically, mortgage rates are on average around 8%. So we're below at 6.6.
Yeah.
So if folks think that that rates are high now, yes, of course they're high relative to a lot of people that refinance at 2.75 or 3%.
And that was only a few years ago.
Yeah, and it's free money. I mean, that's free money, and that's certainly a huge dynamic at play in the housing market, which is if you are going to sell something, you're basically going to have to buy something and mortgage something at a rate that's double what you're used to paying.
Which is why a lot of people are sitting on the fence. Anyway, What I was about to say is real estate experts are claiming that when that interest rate drops down under 6, maybe into the 5s, probably not as low as 4, but who knows, that the prices are going to go up even higher. Again, supply and demand, opportunity. How can they go any higher? Bernard Baruch said the tree doesn't grow to the sky. But how is it possible that everybody's home in Southern California is worth at least $1 million to the sky's the limit? How is that possible?
It's all about supply and demand, and so there just hasn't been enough housing that's been built in California relative to the amount of people that are here that want to live here. And so it's a unique situation that's in Southern California particularly, because if you look at San Francisco, prices there have been plummeting. and so that's a totally different supply and demand at play, and so here in SoCal we're very fortunate that we happen to live where everyone else in the country apparently would like to be. Still, even though we've had tremendous numbers of people leave, but I think the numbers of people that have left are more representative of people who are in maybe much wealthier people, people that have tax incentive to really leave. And
but what does that do to the state of Cal? What does that do to the state?
It doesn't impact supply and demand. Well, it definitely restricts the amount of money that the state can expect from tax revenue.
I mean, when you're big earners and your corporate people take their multi-million-dollar salaries and go to Texas and wherever, it's got to make a difference.
Well, and so New York, obviously the other big state in the union, they're running a deficit of about $6 billion. Well, in California, it's about 10 times that. So it's a huge problem here in California. Its tax receipts remember just a couple of years ago, there was a huge surplus that the government was running, and that was basically eviscerated within 12 months. So it's a nice thing when you have it, but the state certainly did not take advantage of running a surplus. They just spent all that money and much more.
Ivan, we have to take our 15-minute quarter break. We will be back in just 2 minutes. Please stay with me. Ladies and gentlemen, I'm Bruce Cook. It's The Conversation live tonight on Angels Radio. We'll be right back, Living in Paradise. My guest tonight, Ivan Illan, who is the chairman and founder of Illan Wealth Advisors Investment Management. Excuse me, I'm fighting a cold tonight. Ivan, you're back. I want to talk to you about strategy for investing in 2024. You manage investment portfolios for a very, very diverse group of people. Most of them are probably high net worth people. When they come to you, do they have a total concept of what they want done and you take orders, or do you advise them? And if so, how do you approach that?
Good question. We advise. We're actually an SEC registered investment advisor, so we have a formal filing that specifically it basically broadcasts that we do advise on investment management, asset allocation, and it is fully discretionary. So when we do get money from our clients to invest the assets, all of the burden of that discretion is on us, and so if we do a bad job, we're going to suffer the consequences of that. And if we do a good job, maybe someone will notice and say, "Hey, good job." But it's a tough business managing money, that's for sure.
Have the strategies changed a lot since the pandemic? Are there steps that you have abandoned? For example, do you advise people if they're buying stocks? Do people tend to buy stocks that are dividend quality anymore, or is that old school and not done? What about tax-free bonds and all the different annuities that are out there? How do you know what to tell people?
Well, when people are entrusting us to make the decisions, and so our decisions are based on fundamentals of what's going on in the global macroeconomic environment. And that's just a fancy way of saying, is it easier for businesses to grow and operate, or is it more difficult? And fundamentally, that's the question I think a good investor is always asking. Is the economic environment more conducive to a business growth or less conducive? And so what's a basic function of business growth? I would say it's their ability to finance that growth and finance their operations. And so right now we have an interest rate environment which has dramatically changed from what it looked like just a very short few years ago. I mean, literally less than 2 years ago, we had interest rates that were, at 0% for the Fed funds rate. So now it's at 5.3%. So this is a colossal move that impacts the cost of businesses to borrow. And, generally speaking, it takes like 2 years before you see the full impact show up in the economy. And so guess what? We are actually just coming up on that 2-year mark in March of this year. And so 2 years since when the Federal Reserve began hiking interest rates. So it's a very precarious time, I think, for businesses.
So what do you tell your client? Hold off?
Well, yeah.
Go ahead.
Yeah, I would say that you have to be very, very clear about where you are investing in the U.S. stock market. And so if you're investing in the S&P 500, for example, just the basic, very popular index, most people should know that last year the S&P 500 was up some beautiful, amount, 20 some odd percent.
Yeah, I read it was 24%. That's a very substantial upswing. What do you attribute that to?
It sounds like we had a great stock market year last year as a result of it. But guess what, Bruce? Only 7 out of 500 companies drove that return. Basically, 90% of that return last year was driven by 7 companies out of 500.
So that's your job, to make sure you know what 7 companies are doing, so that the client can be invested in the right place.
Well, or to make sure that that they're not the last one getting off the boat if that ride is over.
Right.
And so that may be more of the situation that we're in today. With certainly prices and values of those very few companies have gone to just unbelievable astronomical levels. And that, from our perspective, is just not something that's sustainable or even justifiable based on their earnings growth and other fundamental factors.
Is there one company you could single out and tell the audience why you think it did so well?
Well, NVIDIA would probably be the most popular story that a lot of folks heard about. And if they didn't hear about NVIDIA specifically, they heard about AI, or artificial intelligence. And so there was a huge amount of euphoria that swept through the stock market earlier this year because AI was going to revolutionize everything. And then there were these few companies that really have a lot of AI product or services in development. And so NVIDIA makes the semiconductors, that are essentially required for the development of AI and the expansion of AI throughout industries. And so its stock was up, hundreds of percents. I mean, it was just an unbelievable, what they say, to the moon, kind of experience. But the earnings certainly are not there to support today's valuations, and there's a huge amount of growth that would need to be attained in order to justify the current valuations. So it's just a good example of how euphoria and that kind of really positive, almost delirious excitement for a particular company can just send prices way, 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 way up. And then, usually it finds its way down to a more reasonable level.
So it's a question of when you get in and when you get out. And that is the age-old question.
Yeah. Buy low, sell high. Repeat. That is the secret to making money in the capital markets.
There you go. That's America. There we are.
Right. Yeah.
In our last couple of minutes together, talk about the NASDAQ and its roller coaster. It did well this year overall also, but there were some really low lows.
Yeah, over the past 3 years, it's been a tremendous roller coaster and really hasn't gone much of anywhere. This year was it did phenomenally better than the S&P 500, but the NASDAQ is more concentrated in technology companies. And so when that AI enthusiasm and euphoria sweeping through the markets, it happens to impact more positively NASDAQ-type companies because it is focused more in the tech sector. And so it disproportionately experienced that upside growth, which, from my standpoint and certainly for the monies that we're managing for our clients, that's way too rich for us, and we're certainly significantly underweight to the tech sector relative to the benchmark. And we're very happy with that. I like to sleep at night. I really need my sleep. I don't like to lose sleep. And so part of that means making sure we own things in our client portfolios that don't really impact that. And I would be very nervous to have those exposures at this point.
You're a wise man, sir. A very wise man. Listen, give us your prognostication for 2024. Are you bullish? Are you skittish? Where do you stand?
I'm more on the skittish side, Bruce, and I think it's mostly because of this real sort of 2-year time frame that historically is when you see the full impact of central bankers' activities. And so this huge rate hike cycle, consumers, businesses, everyone's been kind of finding a way to adjust to these higher interest rates, but usually it's around that 2-year mark that we see historically that it starts to really be digested in with consumers and businesses, and that means having to pay the piper a little bit.
So based on that, I would project that we are in for some surprises as the year moves on, and especially how it relates to our national election. On that note, please tell us how our audience could reach you if they so choose.
Sure. You can go to our website at www.alignwealth.com. That's ALIGNE wealth.com. Or give us a call at 310-795-0622.
310-795-0622. Ivan Illan, it has been a pleasure having you on tonight. Thank you so much for coming back on a regular basis. We appreciate your wisdom and your thoughtfulness. Happy New Year to you. Go to your window and look at all those fancy cars and enjoy the rest of the night. And you can turn on the Golden Globes.
Yes. Thank you, Bruce.
Okay. Take care.
For more deep thoughts, please subscribe to this podcast. Also, please feel free to visit www.ivanillan.com to submit questions or topics through the contact page. Until next time, keep thinking deeply.